Welcome everyone to the initial voyage of Shutter Downs Wealth Management's private equity podcast video series called Traditional to Seed and Everything in Between, where myself and my colleague, Matt Biggs, who you'll meet here in a moment, talk about the comings and goings in private equity, and specifically, the status of markets, deals being done, status of fundraising, and the overall exit environment. So kind of a lot to talk about as we get into this. Matt, good to have you. Really excited about this first.
Happy to be here. Yeah.
Kind of a long time in the making, lots of outlines being done, but we're going to get started. So this is a sister podcast video series called Hard Hats, Shovels, and Lunch Pails, which takes a look at things like infrastructure, farmland, timberland, commercial real estate, kind of the things that make the economy go. And in a lot of cases, this is a nice, kind of sister series to it, which is talking about a lot of the companies are moving markets, are helping us with our day-to-day lives. And in the case of, the all-encompassing artificial intelligence, things that are changing our lives potentially, right? So we're going to talk about that. And as the title of this traditional, which is kind of traditional investing, seed, the very early beginnings of venture capital, and kind of everything that's in between those, we're going to talk about. So for those of you who don't know, I am the Chief Investment Officer of Shutter Downs Wealth Management. My name's Jason Staley. I'm a chartered financial analyst and a chartered alternative investment analyst. Really excited. And again, kind of Matt Biggs. Maybe you introduce yourself and we'll get moving.
Yep, Matt Biggs. I am a wealth manager. Similar to Jason, I hold my Chartered Alternative Investment Analyst designation, and I'm also a certified financial planner. So I have found private markets very interesting over the past 3 to 4 years. So made it a goal to go and get that Chartered Alternative designation, and now I am helping Jason out with our private equity market coverage. So happy to talk about it today. We'll give a quick shout out. I did do a Coffee with Alyssa. So give a shout out to one of our other video series talking about private equity markets. And it was a very basic, kind of what is private equity. And I do go into a little bit of details on some of the genres. But I think, if you watch this and you want more, that's a good place to start on our website. So if I were to play off the title, traditional to seed and everything in between, I'm going to start by talking about what is traditional. I'm going to keep it pretty brief, but think of traditional buyout as, purchasing an established company with the goal of, improving the way it functions, whether that be operationally, whether that be financially, whether that just be putting different checks and balances in place. But the overall goal is buying solid companies that just need a little bit more direction and then really taking them to the next level. So that would be the traditional part. The seed, I think, Jason, you mentioned it. Also think of that as venture capital. I think a lot of times when people hear private equity, venture capital seems to be one of the things that they immediately kind of go to. And it's a segment of private equity, and venture capital would be, new or growing businesses with high, long-term revenue projections and growth potential. So, you've seen some of the biggest names in tech have started out as venture capital companies. And Jason, I know
Mark Zuckerberg, right? Mark Zuckerberg, right? He started Facebook in his dormitory at Harvard, and didn't take capital for a couple of years, but eventually someone made a seed investment into that, and the people that made those seed investments in companies like Facebook, very happy that they
certainly happy today, right?
Certainly happy today, especially if they held on to their investment. But I think it does encompass. You have these traditional businesses, manufacturing, industrial businesses. A lot of times that many people, that don't know. They don't have the name recognition of Deere or Caterpillar traditional industrial kind of cyclical plays, but they play a huge part in our role in our lives. And similarly, on the venture capital side, there are a lot of different companies that get created with seed rounds of investment that then go on to be sold to Microsoft or Amazon or Google, and you never hear of them, but they play an integral role in the technology companies that are driving forward this AI revolution. And so I think we've kind of got the subgenres kind of figured out, right? You've got the traditional buyout, and then you have venture capital investment, but there are other topics that we are going to talk about over the course of this video series. Some of them kind of what's the difference between a limited partner investment in a private equity strategy and a co-investment. What are private equity secondaries, and how has that evolved? What's a GP-led secondary? These are all things that we're going to talk about in greater detail once a quarter as we talk about what's moving in private markets. And so not going to go through all of that today, but wanted to make sure that we kind of touched on asset classes and styles and strategies that we'll be talking about in the future. And so when we think about the current status of private equity markets, Matt, there are a lot of, I think if you're doing the Venn diagram with public markets, when you look at kind of the overlap, I think where you see a lot of things kind of affecting the markets are kind of interest rates. And the interest rate market prior to the start of 2022 was incredibly favorable, right, to private markets. Low interest rates, low inflation, not only saw spectacular returns in a lot of cases in the private equity and venture capital space, but also a significant amount of money raised. And maybe kind of talk a little bit about how the interest rate market, how that's really affected IPOs, initial public offerings, but also just sales to strategics and the overall deal volume that we're seeing in private markets.
Yeah, and really, if we go back, and if I was going to plug some of your other videos and some of your other commentary that we put out there, Jason, it's not all too different than what we're seeing in small cap right now, right? Where interest rates are affecting what you can borrow at. And for small cap companies that are on variable lines, or for private companies on variable lines, that is a very real impact to what their bottom line is. So we've seen this, from the beginning of 2022 through really, it's September 4th right now as we record this. We have seen this rate hike cycle, which we believe will be coming to an end. But that has had a major impact on valuations of some of these private companies, and it's made it hard for them to borrow. It's made the marks go down and their valuations go down. So it's a very interesting time, because as we go into this potential rate cut cycle, we could start to see some of these companies turn around and start to see these companies get written back up.
Yeah, and I think that you kind of hit the nail on the head there, and you look at kind of companies like Microsoft and Apple, who totally revamped their debt structure, and they put low cost fixed rate debt on during COVID, and that's one of the reasons that you've seen their outstanding return, right? They have this low fixed cost. They're not necessarily going to be the big beneficiaries if interest rates decline. But what we have seen, a complete and total lack of deals being done. Not, I guess, that's probably too strong, but I think you've certainly seen deal volume decline. Initial public offerings, is the window open? Yeah, the CEO of Jefferies says that it's open, and I think that if you are a very successful company that's got good financials, can you IPO your stock? Yes. So is it going to be a success and trade above the IPO price? Possibly, but it's certainly not the receptive market that we had in 2020 and 2021 in the very beginning part of 2022. And I think that's where, when you look at what can unlock and what's kind of facing private markets, is that you had this big run up, right, in valuations and in terms of where funds were being marked. And then as interest rates continued to climb much more than the market expected, market participants kind of had to adjust. They had made these commitments, throughout 2020 into 2021 and into 2022 as well. You saw the pace of those commitments slow down. You saw deal volume again kind of go down, and it's become more of the transition has now been, in the venture capital space. There's more of an emphasis on show us your pathway to profitability, not growth at any cost. What is your pathway to profitability? If you're not a high growth company, it's show me that you can operate your free cash flow. Show me that you can pay down debt. Show us that you can do accretive tuck-ins and acquisitions. And so it's become much more of a transition into what I would call, like, we're in this kind of operator phase, right? I think we're really in the decade of the operator, where the easy money, quote unquote, and I don't know that it's ever easy. That term gets thrown around, I think, a little bit too much, but just the low rates, the low inflation, that era is over. And as we transition into this new market environment where the money actually costs something, where the barrier to IPO is much higher, kind of the SPAC craze that that came to color a lot of 2020 and 2021. Those vehicles are I don't want to say dead, but they're certainly dormant. And I think that's what really is interesting about what we're seeing in the market, right? And so it's taking these blue chip private equity managers much longer to complete their stated fundraisers, and the hold periods for a lot of their investments are longer, and that's causing limited partners like our clients, right, like allocators like Schneider Downs, endowments, and foundations to really look at the pacing of their investments, who they're putting capital with. It's certainly been interesting to watch, because in the matter of like 3 or 4 years, we've seen kind of the highest of highs, the lowest of lows, and now we're kind of working our way through it.
And from an LP perspective, so if you're a limited partner investing in one of these deals, and the pace of capital that's being called right now has certainly felt like it's slowed. And I think you could look at that a few ways, but the way we would look at that is, well, that's positive, because that means we're not reaching. The managers we deploy and that our clients are in are not buying companies that they feel aren't good deals. So it's, we kind of had this 2020, 2021, 2022 peak, and then market reset a little bit because, well, capital isn't as cheap, right? So now that we're borrowing and there's an actual cost, a real cost to borrowing money to go invest in these companies, we've seen, a little bit more due diligence and a little bit more patience, making sure we see, the right deals and the right valuations. I think some of the valuations we saw people paying and the numbers and the multiples we saw in 21 and 22 were just, we had to kind of take a second look at, right?
And I think it's natural. And it's not to say those companies, when you see the term down round, when someone raises money at a lower valuation, so they did a down round in Series D, that just means that the valuation of the company, or what investors perceive that company to be worth when they raised their Series D, is lower than it was when they raised their Series C financing. And there are plenty of good companies that have done down rounds that have gone on to be profitable. But it does go to show you that if you're doing a down round, or you're doing some venture debt, bridge financing to get you to your next round, so you don't do it you don't get the negative connotation of having a down round. There's certainly been a price reset in the market. And I think that you've seen that, the Preqin and the PitchBook data would show that, I think in the buyout market, broadly speaking, we finished 2022 right around 12 times purchase price to EBITDA, which is, for those of you that aren't familiar with that metric, it's very similar. It's kind of the private equity equivalent to the price to earnings ratio. Not the perfect measure, but it's as close to apples as you could get in terms of public versus private. That flipped to, in 2023, that flipped to kind of a little bit under 11 times. purchase price to EBITDA, so you saw a little bit of contraction. In the beginning of 2024, it's right at around 11 times. So you've certainly seen that on the buyout side that it's come down. On the growth side, the growth equity, the venture capital, that's where you've really seen it. And so that's where I think we'll kind of end this with talking a little bit about the IPO market and what has gone on there. And so they've had kind of three big successful IPOs. Maybe walk through that, and then we'll talk one very large deal that almost got done but didn't quite get to the finish line, but led to some promise that some of these very good companies either will be going public or will be selling to a strategic. So we'll kind of end this on the glass half full.
And that's what I was gonna say. Is maybe it felt hopefully it hasn't felt too pessimistic, but Jason, let me talk a little bit about the more recent one that really hit headlines, and then I'll let you kind of give a little color there and fill in on some of the other successful IPOs. But if you had been paying attention in the news, July this year, so within the last couple months, Google was in talks to acquire a cybersecurity company called Wiz. So, I remember the day that hit CNBC, kind of the tape, $23 billion acquisition of Wiz. And another example of a company that's valued at $23 billion now, at least that's what Google was willing to pay, and started as a venture capital company. Now, I think what's interesting is we had the CrowdStrike going on at the same time, and there's multiple things that I think why Wiz backed it, this deal did not get done. And one of the things is belief in the company. So their goal now is, hey, we've seen some successful IPOs, which Jason will hit on. Let's focus on continuing to grow our revenue at this rate that we have been. We're working with some of the biggest companies in the U.S. right now and globally. So let's continue to grow our client base, and let's have our own successful exit through an IPO. And that's kind of the goal right at this point.
And I think it does show from Wiz's standpoint, and that they're backed by Lightspeed, Sequoia, Green Oaks, Andreessen Horowitz, I think Index Ventures, kind of a who's who of venture capital and growth equity firms, and certainly the most prominent of the companies to kind of potentially have these big exits. And this would have been one of the bigger exits to a strategic that I can think of, right? And there were talks that maybe there was some antitrust going on, antitrust concerns. Ultimately, the deal did get done, but you kind of look at it as, okay, for these companies that are really good, that have a viable product, that have really good customer bases, high recurring revenue, that there's demand there, right? Wiz didn't get bought by Google, but again, it kind of showed a pathway where to companies that, hey, maybe the markets are starting to thaw a little bit. And we had kind of, in addition to that, I would say kind of three, IPOs that I thought were at least received initially very well. So Reddit, Birkenstock, and Raspberry Pi, right? Which brings us to kind of what are we going to be talking about in the future? And we wanted to introduce this video series, talk a little bit about our background, talk a little bit about the kind of the asset classes and the subsectors that are really going to be driving this moving forward. And then, the last of it is, in the future, what do we see? And we want to be talking about big deals that are being done, big funds that are being raised. Hopefully in the future, it's a lot more fun to talk about successful IPOs than not successful IPOs. And hopefully, we're able to talk about these high profile exits and give you a little bit of insight and color into how these deals happen and why they're selling to certain strategics, things that maybe you might not get outside of kind of the press clippings in the Wall Street Journal. And so we certainly think that private markets are interesting. They are not for everyone, but for investors that can handle the illiquidity and meet the accredited investor and qualified purchaser standards. Matt, we've found that they are a good complement to a traditional portfolio. And we're really excited to bring this conversation not only to our clients, but to friends of the firm and hopefully future prospects that are watching us. So on behalf of Matt and myself and our teammates on the investment team, at Schneider Downs, we look forward to bringing you more of traditional to seed and everything in between. And until then, Matt, thanks for joining, and look forward to talking to you guys about it more.
Yep, looking forward to it.
Take care, guys. Have a good one.